All right, so let's get into this right quick, man. Here's 5 things that I want you to understand in this market. Right, I want you to understand the rate hike in November. I want you to pay attention to that. I think we'll get 50%. I don't think we'll get 75. I think we'll get 50. Right, I don't think we'll get 75. I think we'll get 50. I want you to understand that the midterm election is important. I want you to understand that the midterm election is important. Here's why. In 2018, stocks dropped by 6.2% during the midterm election. Right? The second year after a presidential term, right, follows a predictable pattern. The average stock returns in the second year of a presidential return. During the second and third quarter, the stock usually dips. The stock market usually dips. Right? So during that second term, I won't say term, the second year of the presidential term. So this is his second year. So usually that second year, the market usually has a decline and then a dip in it. And usually that second, third quarter of that second year are the most harshest quarters, followed by a rebound the first quarter of the next year. That's just history, right? That's 68% of the time. The stock market usually sells off during midterm elections, right? Historically, it sells off during midterm elections, and then, after that, it bounces back. So only thing I'm saying right here is we're looking at the midterm election. It's important. Just historically, I like to follow the data. I like to see what the data does. Data isn't always 100%, right? Data is usually somewhere between 68 and 80% correct, right? I always have wiggle room, but I always like to follow the data and so I can educate myself on what's going on. And my goal is to educate you each and every Trappin Tuesday. Another thing we got to look for is quadruple winching, right? Which happens 4 times a year, right? We're looking for the next winching December the 16th. Right, so quadruple winching happens on 4 different types of contracts, right? It happens on stock index futures, it happens on stock index options, it happens on stock options, and single stock futures. The 4 different times: stock index futures, stock index options, stock options, and stock options futures. I'm sorry, single stock future. This is the date which options contracts expire simultaneously, right, all at once, and it can cause extreme volatility in the market, right? So we definitely want to pay attention to that on December the 16th, quad winching. If you ever took my options masterclass, we love quad winching because 5 to 10 days after quad winching, as my girl Khadija said, this is where the magic happens at. Right? The next one is macroeconomics. We definitely need to pay attention to that, to what's going on in the economy. But to me, one of the most important things to pay attention to is the VIX, right? And the reason why I want us to pay attention to the VIX is because the VIX measures the market in real time within 30-day increments, right? Within 30-day increments. Why? Because the VIX consists of short-term options on the SPX, right? Which is the S&P, right? So the VIX has short-term options contracts on the SPX. Now, what you need to understand about the VIX is this. When stocks fall, the VIX goes up. When stocks fall, the VIX goes up. When stocks go up, the VIX goes down because the VIX is measuring volatility, how quick stocks are. I want y'all to take y'all time and listen to me right here because there's going to be some game I'm about to give y'all, right? This is some real game I'm about to give y'all. I'm going to say this again. Jose, make sure this is a clip, right? So we paying attention to the VIX because the VIX measures the market in real time in 30-day increments, right? Remember I told you the market is a forward-looking mechanism, right? So it consists of short-term options in the SPX, right? So when stocks fall, the VIX goes up. When the stocks go up, the VIX goes down. Now watch this. The VIX above 30 suggests that we are in high volatility, right? The VIX above 40 represents we're in a sharp recession. Now watch this. There's a thing called the rule of 16, right? There's a thing called the rule of 16. If you divide the daily VIX by 16, this is the suggested movement in the market, right, that is going to happen next, right? Now, think about this. Why the number 16? So 16 is the square root of the number of trading days in a year. So there's 252 trading days in a year. The square root of that is 16, right? So 16, there's the thing called the rule of 16. If you're a trader, especially an options trader, you truly need to pay attention to this, right? You truly need to pay attention to this, right? Because this can help you in a lot of ways. It's not a secret. It's not a secret or nothing. If you're a trader, this is one of the tools that you should use, right? If you're a trader, this is one of the tools that you should use, right? So I wrote this out for you because I said this is important, right? So again, anytime the VIX is above 30, we're experiencing high volatility. It's saying we're going to have high volatility, right? If the VIX is above 40, that means we're in a sharp recession. Sharp recession. Sharp recession. Now, here's the thing called a rule of 16. You can go look this up, but I'm breaking it down for you so you can understand it. That way, once you see it, when you go read it, you can say, okay, Trap told me this. Boom, now I can make 2 and 2 make sense, right? So if you divide the VIX, by 16, why 16? 16 because 16 is the square root of how many trading days we have in a year. 252 trading days. The square root of 252 is 16. Right, so here's what happens. Now, this is a suggested what the market will go up or move by next. So let's think about it. If the level is at 16 and we divide 16 by itself, we get to 1. So we're expecting now the market to move by 1%. Right, if the VIX is at 24, then we suggest the market to move by 1.5%. Right, if the market is 32, now we're expecting the market to move by 2%. If the VIX is 48, we're expecting the market to now move by 3%. Now, Trap, how can this help me? Well, if you're an options trader, this can now help you do this. It can help you now select options prices and find entry and exit movements. Why? Because 2/3 of the time, not 100% of the time, but 2/3 of the time, the market will abide by the rule of 16. Woo! God! Like they say in the hood, put that in your pipe and smoke it. Now, here's some key takeaways of what I gave you, right? Understanding how to use the VIX to help you indicate how high the next move in the market might be. Remember, it is not an exact indicator, but what it is a tool to help you find perspective. It is a tool to help you find perspective. That's all it is. It's not a, this is a 100% of the chance. This is just a tool to help you find perspective. This is what big investors use. This is what hedge funds use. This is what most traders should use. And so if you got somebody that's teaching you, options, like I'm not a day trader. This is especially good for people who are day traders, maybe scalpers. You can go look it up. This ain't nothing I'm lying to you about. If you go ask anybody that is a professional options trader, right? Somebody that's a professional options trader, this is one of the things that I use. I look at it, but I don't consider myself a professional. I know how to use options to make money. You know what I'm saying? I'm not the guru. I'm not the guru of options. That ain't my thing. I can teach you how to make a couple dollars, but I ain't gonna never get up here and say I'm the best options trader in the world. That ain't me. You know what I'm saying? I've made money. I've made more money than I've lost. 100% of the time, my ratio is probably 10-1. I probably got an 86% ratio of winning, right? PayPal probably took me down to about 72%, but I'll still live with that. You know what I'm saying? I'll still live with the 72%. But you'll never hear me say I'm the best options trader, right? But what I will say is if you've been rocking me for a while, you've seen me get on Instagram and do a couple options trades. You saw me make $100,000 in a day. You've seen me make $50,000 in a day. You've seen me make $60,000, $70,000 a day, but you also seen me lose money. You've seen me show I lost $19,000. You've seen me show I lost $100,000 to my trappers. So I'm always transparent with that. So I'm not gonna have a $25,000 options class. You know what I'm saying? Like I'll have an options class. It's gonna be reasonable for you to get, and I'm gonna say, hey, this is how Trap made money. You know what I'm saying? Using it. So that's my thing. You got to go to Terry or Aristotle a couple other people that really like live and breathe options all day, every day. I don't do it all day. I actually do 6, 8, 9, 12 in 1 year leap options and let that thing run. You know what I'm saying? I'm just being real with you. You know what I'm saying? I'm not a professional, but I am pretty damn good at them. Again, so here's what you learn from the rule of 16, right? You understand how to use the VIX to help you indicate what the next move may be in the market. Next, the rule of 16 helps you with options selecting strike prices, right? And it also helps you look for entry and exits. Why? Because, again, if you're using the rule of 16 and you measure it with the daily VIX, then if you cut it in, once you use it, say, hey, the market may move 1%. 2/3 of the time, 68.9% of the time, the rule of 16 is correct, right? It says, hey, we're looking for a 1.5% swing. You know what I'm saying? So this actually can work for you a lot. So if you like that, love it. Want to give y'all some game. It's only one of the tools you have in your chart, right? So I hope, from an options trader, you like, damn, Trap, that's that sauce. If you're not an options trader, don't worry about it. You can just use it from time to time, look at it.